Almost 2 years have passed since the beginning of this pandemic. And I think now it's important to look a bit at those times and at the beginning of this pandemic and understand how your companies and you face the business and the client's expectations as well. And to talk about these topics and other topics, we have today Ramon Carrasco, Business Development at Carminhac, Juan Carlos Dominguez, Managing Director at AXA Investment Managers, and Daniel Pingarrón, Sales at Natixis Investment Managers. And Ramon, we can start with you.
Excellent.
A year and a half after the first lockdown in March of 2020, how do you see now the relationship with your clients evolving in the near term and the long term as well?
Yeah, I think that in order to analyze the future, let's to look how it was in the past. Before COVID, all the relationship with client it was with physical meetings, face to face. With COVID, it changed dramatically. We moved to a digital relationship, Teams and all those platforms. What will happen in the future? I think that we will take the best of the era before COVID and the era during the COVID. I mean, we will maintain or we will come back to physical meetings and we will have digital meetings. So I'm afraid we will combine both relationships because we have to take the best of both worlds. I think we are not going to have only physical meetings. We are not going to come back to the previous world before COVID, but I think it's quite useful, not only physical, but keep in touch through digital communication. I think we will save time, but at the same time, it's worth it to have face-to-face meetings with clients since we need that kind of relationship. So at the end of the day, to sum up, we will have physical and digital, both. But it's a process that it will take time. I think in 6 months or less than 9 months, we will have that new environment, physical and digital.
Mm-hmm. Juan Carlos, do you also see that balance between the both worlds, physical and digital?
I'm totally agree with the reflection of Ramon. I personally need to go back to physical contacts because it's true that these, let's say, online meetings are a little bit, we are abusing a little bit of these digital meetings. I think people is really fed up of this type, but it's true that it makes a lot of advantage. I just to give you an example, some strategies, complex strategies just for some institutional clients that I was not able to show to some institutional clients in the past because maybe I was not able to fill an agenda for a portfolio manager to come to Lisbon or Porto to meet 3 or 4 clients because maybe I thought it's not enough, let's say, staff to bring this guy from Paris or from London, etc. Now or from US, now it is quite straightforward. No? I saw the other day, I watched the other day a conference organized by McKinsey regarding the future of technology. And they said one thing quite interesting that we already know. And it was, we had the means before, but this COVID crisis has sped up 7 years the implementation of these tools. So as Ramon said, it's true that we need to combine both, keep the best of both, but I'm really eager to reduce the number of telematic meetings and have more personal meetings.
Mm-hmm. And Daniel, the clients are reacting well to this both ways to communicate.
Yeah, I think so. I completely agree with my two colleagues. So at Natixis Investment Managers, we like to think we are a client-centric organization. And this business, this industry leverage on trust. I mean, being transparent and being close to our investors is absolutely key. During the lockdown, Juan Carlos pointed this out a couple of minutes ago. It was key to be close to clients, and the only way we had to, react or be close to clients was with these kind of Zoom sessions or with these telematic new platforms. You just need to check the quotation of these companies in the indexes. Yeah. They were, rocketing last year. We need to consider also that beyond the COVID crisis, we did have a market event last year. So from March to May, we saw the biggest volatility ever. We saw drawdowns of over 30% in equity markets in Europe. Credit markets also collapsed. So it was key also to, be transparent, sharing the views of the PMs with investors, sharing all the future view of different PMs on different asset classes. So it was key, it was crucial to be to make an additional effort to be more transparent and give every explanation needed. Looking to the future, we also favor or would favor physical meetings and events than these online events for very sheer reasons that both Ramon and Juan Carlos commented perfectly before. For example, we have started to have this physical roadshow. Last week in Spain, we had our first roadshow with a couple of PMs coming from the Netherlands. And I think that we are also willing to start this kind of, back to normality and have some kind of PMs and physical meetings in the coming months. For sure, there will be a balance between physical events and these online events. But again, we came from 0% on physical events in the last year and a half, and we should reach some kind of nice balance between these two new worlds.
Mm-hmm. And other topic that we saw emerging even more strongly in the last couple of months was ESG investment. How do you feel, and Daniel, you can continue, how Sure. do you feel the demand from the Portuguese clients about this area?
This area. We have seen a very big improve in the interest of institutional Portuguese investors in ESG topics. I would say that retail investors or wholesale investors are a little bit delayed compared to what we see in other countries. But it's true that in terms of institutional investors, I mean insurance companies, pension plans, in the last 12 months, we saw a big upside in the interest of this kind of investors. We also think that many Portuguese investors think that this new MiFID regulation is very far. And in our mind, in our experience, we could see some kind of acceleration in the implementation of this MiFID regulation. So maybe it's a good idea to pay more attention to these ESG topics right now as we speak. At Natixis Investment Managers, we do have a team, a department, a consultant team called Natixis Solutions with huge capabilities in terms of ESG diagnosis, advisory, or reporting. And we are helping different Portuguese investors in order to analyze their portfolios, see how is their ESG scoring, and helping them, advising them how to improve this ESG scoring and mitigate ESG risk. So we are doing lots of stuff on ESG with especially institutional Portuguese investors during the last 6 months, and we aim to continue this way, and also could be able to help retail investors that, again, they are a little bit delayed in terms of ESG interest compared to other countries we see in Europe.
Ramon, do you also feel that delayed by the Portuguese clients comparing for the Spanish ones that you follow more closely?
The point that I have to highlight is that by regulation, by law, we are not allowed to talk to the end client, to retail investor. But I see that the Spanish retail investor and the Portuguese retail investor, they have the delay that Daniel said. It is true that institutional investor is a key element, the ESG aspect, Article 8, Article 9, and some clients, not only in Spain, but also in Portugal, they require that to buy a fund, to invest in a fund, that fund should be included in a focus list. And that focus list require the Article 8 and Article 9. Retail investors, they don't have that structure in their mind. They mainly focus on return and sometimes in volatility. In that aspect, asset management companies, salespeople, we have to promote, we have to mentor in that process to retail investors in order to put that ESG concept in the matrix of investment for those people. It's a matter of time. It's a wave that came and will continue in the future. And we have keep going, and put that message in all the investment ideas, investment structure. And at the end of the day, they will receive that aspect and they will put it in the investment matrix. But right now there is a delay. Retail investor in Portugal and in Spain, definitely.
Okay, and Juan Carlos, regarding the selectors demanding, do you see the Portuguese selectors asking for funds that are including in the 9 and 8 articles of the regulation?
Well, more than asking this particular topic, which we see some demand asking for what is your offer in the Article 9. What they are also doing is to classify and get information about what are the articles of the funds selected by these fund selectors. Indeed. So as my colleague said, the traction of ESG funds comes from top down. It is the companies are the selectors, the entities, the distributors, the institutions are asking for this type of funds, and thanks to the FDR regulation, now it is more clear, and you can easily classify what is the level of ESG, where the bar is, because before it was a nightmare. You had some stamps from one country, from other country, with different standards, and sometimes not from our standing, not enough clear and not enough good. And now with this taxonomy, it's much more easier to classify the level of ESG of each fund. So yeah, at AXA Investment Managers, we have 85% of the assets with Article 8. So for us, it's a mainstream because we have our parent company, AXA Group, as a main driver of this ESG trend, because it is also for our business, because the insurance business, if the global warming continues, the world won't be able to be insured, and our mother company is an insurance company. So we are really concerned, not just because of it is a nice thing and it is let's say a responsible thing. It's because it's our business, and we will impact it seriously due to the global warming. So what I want to highlight is that there is not demand from end clients so far. It is more now what private bankings are doing is to, let's say, to classify, to push ranges, to push services with a higher standard in ESG. Mm-hmm. And institutional, of course, they are more aware of the need, because they also need to reporting on that. It's true that the ESG, well, I don't want, maybe this topic, I wanted to mention other topic in the ESG space, but I think it's a little bit long for this discussion. Sorry for that. I stop here.
Okay,
Margarita, sorry.
It stays to another conversation, another time. During the last couple of months, now years, we have an environment of low interest rates that affect all your clients, and they try to look for some other solutions to get some extra yield. How do you see that clients facing that environment, and what kind of solutions are they looking for in order to get that extra yield in their portfolios? And Juan, if you want, you can continue.
Okay, what we have seen, but it is true that it is our gut feeling, is not what I'm telling you is my personal view, is that we see less traction in balanced funds, because maybe on general, maybe of course there are exceptions, but on general, during the COVID crisis, during the crunch, and then the recovery, they didn't perform as expected for some clients. And also on the other side, the technology funds and the thematic funds skyrocket. So what we are seeing is more appetite for pure global equity funds in this thematic, because also they understand what is behind, etc., etc. Less appetite for balance, and a real barbell approach in the investment. So pure equities and then non-risk in the fixed income side, because they don't see value there.
Mm-hmm. Daniel, what are the solutions that you feel the clients are demanding right now?
Well, we are seeing, I would say, two highlights here. First of all, right now, we see most of our investors are decreasing duration risk. So the appetite on short duration strategies is very remarkable right now. The other big movement we see here is investors have appetite on credit risk. So let's put it this way. Investors are decreasing duration risk and favoring credit risk. And we think it's a very good approach right now on fixed income markets in general. So regarding this, we are seeing some, increasing interest in with low duration 2, 3, and seeking for this additional yield that is tough these days to find, yield in Western markets. Other story is emerging markets. And shooting the former, talking about emerging markets, we do see interest in hard currency, corporates, investment grade, short duration strategies where you can find yields 3-4% with a global approach. Emerging markets are, as everyone knows, less efficient than Western markets. So you don't need to assume an additional risk premium in order to have a good yield. So in our mind, it makes sense to remain exposed to this market. That is true that, and we saw recently with the Evergrande case, this year, maybe they are not performing so well as expected, but we see upside and potential on that area, on that asset class. And in Western, or shooting the Western markets, we see interest in this kind of crossover strategies. So the border between investment grade and high yield in Europe, corporates, for example, with short duration, shooting or seeking for fallen angels, for example, that recently lost their grade rating, but the default likelihood is controlled or is assumable, is another interesting strategy. And lastly, we saw interest in a new kind of strategies named ultra short duration. This is an alternative to money markets or to cash. We see that there are big positions still in cash, in pure cash. Those positions are performing really bad, honestly. So we are seeing an increasing appetite on trying to, invest a part of those cash or those exposure to money markets with the ONIA in negative and so on, in this kind of ultra short duration corporate strategies, assuming some kind of credit risk, but reducing a lot the duration risk. We are speaking of durations below 0.5. So very, very, very short duration strategies. I would name those three strategies as some ideas that could make sense these days.
Ramon, do you also see that the money going to short duration strategies, and for the other side, as Juan mentioned, to some equities strategies as well? So that
I'm totally agree with what Daniel said. Keep in mind our current scenario. We have inflation figure. It is a risk. Look at the inflation figure, not only in Spain or Portugal that we know this week, but also what the Fed said last week, or the Bank of England. It's a matter that it is here and will last for a couple of months, several months. Look at the strategy of the tapering. It's a reality that it is here right now. Look at the steepening of the curve. Look at the yield evolution. Look at the current yield of the 5-year tranche or 10-year tranche. In that scenario, what the client demand is flexible solution. With that scenario, we translate flexible solution into negative modified duration. It's quite easy. If yields goes up, price goes down. So you must implement a negative duration strategy. If you implement that strategy, and it happened in the past, in the last 20 years history, you will have positive returns. The point or the doubt in that strategy is for those funds that are not allowed to implement short modified duration, what we call the long only. If you have that problem, you're in trouble. You are not going to be able to deliver positive return in the next 12, 24 months. So the key word right now is a flexible strategy, flexible solution, and we have to translate that flexible with the capability to implement negative modified duration. If you implement that strategy, you don't have any problem with this scenario of inflation, tapering, steepening of the curve, negative yields goes up. It's a new opportunities that we receive from the fixed income market.
And regarding the alternative strategies, the 2020 was a challenging year for those strategies. It was a year that tested all the capacities of those strategies. How do you see these strategies reacting right now? And how do you describe these the demand from the clients on these strategies? And Ramon, you can go on.
Yes, I think I'm not going to talk about the result of that strategy regarding all the competitors, because the result has been quite broad. There's a significant positive result of negative result. Just focus on our strategy, on alternative strategy or absolute return or long short. We are really satisfied with the result of that strategy. We are really satisfied with the flows that we receive in that strategy. And at the end of the day, if you are an investor and you have some challenge in the market, what do you demand at absolute return fund? Well, positive returns, low volatility, and if it is possible, low correlation with stock 600. If we look at those parameters, we are really satisfied, and we have to say that the trust that we receive from Portuguese investors in our long-short strategies has been really extremely positive in the last 12th, 24th month, in particular since the beginning of the COVID. The AUMs of that strategy increased significantly, but it is true that if you look at the 5-year track record of not only 5 years, just focus on the 2020 track record with a January, February positive return, then collapse of the market, then return of to positive return. The fund performs extremely positive, and the investors saw that we are really active, dynamic, and if you put that result, not only the 2020, but the last 5 years, the result has been really positive, but keep in mind, positive return, low volatility, mid-single digit, and low correlation with stock 600. So we are really satisfied with that strategy and the welcome that Portuguese investors did to our strategy.
Juan Carlos, these strategies have to be analyzed in more long term to have a real flavor of what they can give to the clients.
Well, what we have seen in the alternative space, and obviously as I focus on what we have in our portfolio of products, over the last year and a half during the COVID started in last year, what we have seen is traction in alternative strategies linked to inflation. It's what we call REDX strategy. This is and we have seen, because this alternative strategy, even if it's invest in fixed income, it's an alternative strategy. It's not fixed income; it's an alternative strategy, and they have been playing the higher expectations in inflation. So, and they have had an outstanding performance so far. But now, and it's quite interesting how sophisticated our clients, now they are moving to a long-only inflation strategy, in our case, a global short duration inflation bonds, because now the expectation of acceleration in inflation is not anymore. We are going to keep a high inflation, but the inflation is not going to accelerate even more. It is going to keep high for a while. We thought at the beginning it was more a temporary, but now it is going to last for 2022 as well, as we see now. And the clients are switching from this alternative inflation strategy to this long-only short duration inflation strategy. And it's amazing how they are switching. So regarding this, at least the alternative offer we have, clients are more tactical. They are not and they are right, because we know how these strategies work and where to get good performance. And this is what we have seen so far. This switch from this alternative inflation to long-only inflation strategies. And so far, it is working quite well, because we play with these expectations of inflation and how the market is working now.
Daniel, do you also see that switch between the alternative strategies to the short duration ones?
Well, what we see is that many investors were very disappointed last year with these kind of strategies. I mean, 2020, we saw the biggest correlation ever. I mean, everything performed bad during February to May, more or less. And we saw a huge recovery from May onwards. Our Natixis Solutions team wrote a paper saying absolute return is easier to say it than to deliver it. And it's true. I mean, they have researched different strategies, and we can bring some takeaways here. For example, in Spanish portfolios, the most conservative a portfolio is, the higher exposure to these kind of strategies we could see. In average, we could see around 11% of exposure on conservative portfolios to liquid alternative strategies. If we go to a more balanced portfolio, we could see half of this, around 6%. Then, for example, the dispersion of accumulated performance of this strategy in the long run is huge. It's very tough to see a specific strategy. I mean, a global macro strategy or even driven strategy, a long short equity strategy, performing well in different rolling periods. So you can see that, for example, in a 5 years rolling period, debt arbitrage strategies performs better than any other. And in another 5 years of rolling performance, we could see a reversion on this kind of performance. So it's very hard to see a steady and ongoing performance of this strategy in the long run. In terms of the correlation, we can say that CTAs, I mean, systematic future strategies, are likely the one that correlates less with equity markets or with fixed income. In terms of fixed income, the higher correlation of these alternative strategies is with high yield, not with investment grade, but with high yield. Looking forward, what I think is that these kind of strategies should have their room, their place in portfolios. But again, the expectations on these strategies should be reasonable, and we cannot expect that when everything is performing really bad, these strategies are rocketing, and then when everything recovers, like what we saw last year, these strategies will go on performing really well. So there are specific tactic periods where these strategies could make more sense or could perform better. In the long run, it is discussable if they really, in average, apport the correlation and absolute return.
Mm-hmm. Regarding the private assets, do you see some demand from the clients? They are asking about this topic or not? Daniel?
Should I answer? Definitely. And again, Portuguese market is paying more and more attention to these asset classes. I would bring two specific strategies that, in our mind, in the last 2 years, we saw a significant increase in terms of interest and assets. It's private debt and also infrastructures. The former one, infrastructures. I mean, all the help from the European institutions with all this 800 billion program to speed up the recovery in Europe and so on, national budgets, there are huge flows coming from public money to this kind of assets, and many investors could take advantage of this opportunity and investing in these asset classes. We are talking about core infrastructure strategies, or even though renewable energies projects, everyone could think. These kind of projects are getting a very big support from public institutions in order to be developed. The other one that I mentioned is private debt. It is true that in the very low yield environment that we are living right now, many investors are willing to assume some kind of illiquidity premium in order to have an additional yield. In 2012, for example, you could buy a Portuguese govie or a Spanish govie yielding 7-8% during 10 years. That's absolutely not possible right now. So in order to keep or chase this kind of sound yields, right now you need to face some kind of illiquidity premium, and there are very interesting private debt strategies that could offer a 5-6% in senior debt that could be a proxy of the yields that we used to see 10 years ago.
Mm-hmm. Ramon, these flows coming from the central banks are also implicating more demand from the clients to the private assets. Do you also feel that in Carmignac?
Yes, we feel that flow is quite relevant, it's significant, and I'm afraid we will continue with that flows in the short term, and let's translate short term with the with 12, 18 months. So it's a relevant topic, a relevant issue that we have to keep in mind, and it will continue. Don't forget that the balance sheet of the central bank increased significantly in the last 2 years. We are talking about tapering, but the tapering is reducing the speed of that increase of balance sheet, but it will increase at different speed. So it's a topic that we have to keep in mind right now and in the near future.
Mm-hmm. Juan, do you feel the insurance companies also looking for these strategies?
Alternatives, yeah. Yeah, indeed. They are the only, as far as I know, because it's true that I cover the Portuguese market, but I don't know 100% of the clients. But we have seen so far a big demand from, well, not big demand, a lot of questions about private assets or private, I don't know how you call it, private, not private equity, real assets or real assets. And where we have seen traction has been mainly in infrastructure equity and also infrastructure debt in insurance companies, I mean, because they are, and also Dutch mortgages, because they are also, it is but it's true that it is, some of these strategies are low yielding, but they fit very well with the requirements of Solvency II for insurance companies. So at the end, it's not only in the insurance company investments, they are not so focused in the risk return solution, in the risk return profile. They have a lot of implications from the accounting standpoint, so they have to think in the P&L of the strategy, the volatility of the strategy. So it is not so straightforward as in for example, in a pension fund or in a fund of funds or in mutual funds. They are more sophisticated and they are looking for other things. So where we have seen more traction has been in Portugal over the since the beginning of the crisis in infrastructure equity.
Yeah. So sorry, Margarita, what Juan Carlos was saying is very interesting, because it is true that you need to consider not just yield, but other stuff. And regarding infrastructure, there are other two very sound properties of that kind of asset class. That is, first of all, flows are very predictable. So volatility is low in the asset class. We are talking about a mix between, public and private sector with regulated infrastructure and regulated prices, and it's a perfect or a very good inflation hedge. So in this environment where inflation is becoming a more, let's say, a problem or issue, the fact that this kind of asset class offers you or provides you a hedge on inflation is very sound for many investors.
Okay. And Ramon, other hot topic nowadays is the investment thematics. They are very demanding. How do you address this trend in your funds? What type of thematics are you including in your portfolios nowadays?
Yes, I think that in that topic, we have to differentiate between equity focus and fixed income focus. Talking about equity, probably we highlight 4 main strategies. The main one is the new consumer. We are talking about e-commerce, digital experience, all that issue that that pop up mainly during the COVID crisis. The second one is the digital economy, all related to big data, software, connectivity, fintech, quite relevant aspect, quite relevant market. The third one is the healthcare or advanced healthcare. I mean, healthcare services, medical innovation, quite relevant after the COVID crisis. And the last one we are talking about climate changes, future mobility, energy transition. So those four strategies are the one that we are betting on. On the other hand, we have fixed income strategy. Here, we are not talking about thematic in general. We are talking more about a strategy, short in core bond, because as we said during this presentation, the negative yields. Non-core, there is carry, so we can take advantage of that market. We can get some profit in that strategy. Emerging market, definitely there is carry. It's true that with high volatility, but there is money to earn. And of course, definitely credit, quite selective in credit. We are in a scenario with reduction of the investment by the central bank, the tapering. But if we look bond by bond, bond picking, even when the spread are really reduced, we can find a return, or we can find yields in that asset class. So at the end of the day, not only with equity asset class, but also with the fixed income in those sector or in those asset class, we can get profit for the portfolio, even when the scenario, the short-term scenario is quite tough. Tapering, BPAs, inflation, volatility, uncertainty about what will happen with the COVID. So tough environment, but new opportunities due to the environment that we have right now.
Mm-hmm. Daniel, do you feel that these investment thematics are very, how can I say, have a push from the storytelling that they have behind them, and that helps the demand from the clients? And I would say the retail ones are much more impelled to buy these strategies. Mm-hmm. But how do you see the Portuguese clients looking for these strategies?
Definitely, the storytelling is very powerful and very helpful. It favors a lot these kind of strategies, but not only the storytelling, but the performance. We saw during not just only 2020, but the last, I would say, 4 or 5 years, a very remarkable outperformance of this kind of thematic equity strategies above just a common equity. I would say that in terms of the Portuguese market, thematic equity strategy are becoming more and more core in portfolios. So many investors are increasing the weight of these kind of strategies in their risky bucket, let's say. But I would also say that there are some kind of confusion or misleading appreciation on this. First of all, we have seen some investors approaching ESG solutions with thematic equity strategies, which is not the same. It is true that thematic equity is likely more sustainable than the average of the stocks we could see in market. But in our mind, the ESG ambition should be considered in the global portfolio and not just in a part of it. The second misleading point that we see here is that many investors think that thematic equity strategies are the same as sectorial equity strategies. Sectorial equity strategies, investing in tech sector, in healthcare sector, or whatever, has to do more with passive investment. So just leveraging on beta, but not seeking for alpha. In our mind, and at Natixis Investment Managers, we do have a boutique focused on thematic equity strategies named thematic asset management. Thematic investments has to do with secular growth trends or forces. These forces leverage on globalization. Ramon mentioned some of these ideas before. Globalization, demographic changes, new regulation, urbanization, these very important structural change that this world is facing right now. So you can face, or you can find very interesting stocks in every sector, not just in one sector, but every sector. So thematic equity is much more diversified, much more structural, and there is a very powerful rationale well, than just investing in a specific sector. So seeking for alpha and betting on these stocks that have a very high growth potential in the coming years, for us makes sense speaking about thematic equity investments.
Mm-hmm. Juan Carlos, and in AXA, how do you approach these thematics?
Well, how we approach the thematic AXA Investment Managers, well, for us, it's a top priority because we see it makes a lot of sense. It's true that at AXA Investment Managers, we bought a boutique in UK in 2005 called Framlington, and this boutique now it is more than 50 billion, the assets under management of this boutique, so it is not a boutique anymore. Right? And it's also plenty integrated in AXA Investment Managers. And this company, this boutique was focused, Framlington was focused on sector investing, growth investing, small caps, etc., etc. So they some years ago, they saw that the growth way was with these themes, the technology, digital economy, clean economy, aging population, etc., etc. So we fortunately we have set, and it is increasing the number of thematics because we see new thematics coming, and also it's true that in our case we try to tackle them in a broad way. And that's why, the reason why we try to, for example, we have a quite successful strategy called Clean Economy. And this Clean Economy strategy, this fund, is not in a niche, it is in a broad spectrum. It covers biodiversity, clean tech, clean energy, etc. We try to have wide themes to be able to have more purity, more universe, more investment universe to invest in, and also having this bigger universe, we can invest in company with a high purity exposure to that theme. So this is how we are doing this. We have some blockbusters, some more successful strategies like robotics, robotech, clean economy, and digital economy. And on the other side, in the fixed income, Ramon was mentioning this, in the fixed income, it's true that here is more the green bond, let's say, approach. And in this space, even if we have a big, more than 1 billion fund there, it is only appetite for pure institutions that want to have this, let's say, they want to do a tick in the ESG topic. Maybe this is not very, let's say, it's not politically correct to say that, no? But it's true that from the performance standpoint, it is long duration fixed income. Also, due to the appetite for this asset class in these bonds, the yield is really is peanuts. So at the end of the day, in the green bonds arena, we see only some appetite, and for this reason, from institutional and retail clients. Okay.
From my side, we covered all the topics that we have planned. I don't know if you want to add something, some extra consideration that you'd like to do. Or
next time, a coffee. All together in Lisbon or in Madrid.
A physical meeting.
A physical meeting, of course.
Absolutely.
Thank you all. It was
our pleasure. Thank you very much, Margarita. It's been
a very interesting conversation with very good insights, at least for me.
Much more to come.
Okay, thank you.
Thank you.
Obrigado.
Bye.
Buen día.
Juan Carlos.
Adiós, Ramón.
Chao.
Un abrazo.
Margarita.
Gracias.